Today, I want to walk through SoFi's Q1 2026 earnings because this was honestly a very strong quarter from the business. But the interesting part is that the stock reaction was not exactly what you would expect from the headline numbers. SoFi posted record revenue, record adjusted EBITDA, record member additions, record product additions, and record loan originations. Net revenue was up 43% year-over-year to about $1.1 billion. Net income more than doubled to $167 million adjust. EBITDA was up 62% to $340 million, and total loan originations were up 68% to $12.2 billion. So just looking at those numbers, this was clearly not a weak quarter, but the stock still came under pressure, and I think that tells you something important. The market is no longer just asking, is SoFi growing? Because the answer is obviously yes. The market is now asking a harder question. Is SoFi growing fast enough, profitably enough, and with enough durability to justify the valuation? And that's really the main theme of this quarter. SoFi is not the same company it was a few years ago. This is no longer just a speculative fintech story where investors are hoping profitability eventually shows up. SoFi is now profitable. It has a real bank funding advantage. It has a large and growing member base. It is adding products quickly, and it is becoming this hybrid between a digital bank, a consumer lending platform, a brokerage and financial super app, and a fintech infrastructure company. But it is also not risk-free. Lending is still a huge part of the business. The technology platform had a weak quarter. Dilution is still something shareholders need to watch. And at around $16 per share, with a market cap of about $20.7 billion, the stock is not exactly cheap on near-term earnings. So in this video, I want to break down what actually happened, what mattered most, what looked strong, what looked weaker, and how I'm thinking about SoFi's valuation over the next 5 years. Starting with the headline numbers, this was a very impressive quarter operationally. GAAP net revenue came in at $1.1 billion, up 43% year-over-year. Adjusted net revenue was $1.87 billion, up 41%. That is still a very strong growth rate, especially for a company that is already doing more than $4 billion in annualized revenue. Net income was $166.7 million, up 134%. So this is not just adjusted profitability anymore. SoFi is producing actual GAAP profits. Diluted EPS was 0.12, which was double the prior year. Adjusted EBITDA came in at $339.9 million, up 62%, and adjusted EBITDA margin was 31%. That margin number matters because it shows operating leverage. In simple terms, SoFi is not just growing revenue by spending endlessly. More of that revenue is starting to flow through the business, and that's one of the biggest improvements in the SoFi story. For a long time, the concern with fintech companies was that they could grow users, grow revenue, and grow hype, but they couldn't actually generate durable profits. SoFi is starting to prove that it can grow and become more profitable at the same time. Now, the way I look at this is that the quarter had 3 major positives. Number 1, member and product growth were excellent. SoFi added 1.1 million new members in the quarter, bringing total members to 14.7 million. It also added 1.8 million new products, bringing total products to 22.2 million. That sounds like a basic user growth metric, but for SoFi, it is really important. SoFi's whole model is based on acquiring a customer once, then selling that customer more financial products over time. Maybe someone starts with a loan, then they open a SoFi Money account, then they use Invest, then they use Relay, then maybe they use a credit card or another lending product. That's the whole financial services productivity loop idea, and the key number here is cross-buy. Cross-buy reached 43%, up 7 percentage points year-over-year. To me, that is one of the more important signs in the quarter, because it suggests SoFi is not just adding low-quality members who use one product and leave. The platform is getting better at turning members into multi-product customers, and that is what can make the business model more efficient over time. If SoFi has to spend a lot of money to acquire every single customer for every single product, that is not very attractive. But if SoFi can acquire a member once and then keep deepening that relationship, the economics can get much better. That is the bull case in a nutshell. The second major positive was lending. Total loan originations were $12.2 billion, up 68% year-over-year. Personal loans were $8.3 billion. Student loans were $2.6 billion. Home loans were $1.2 billion. This is where SoFi is still showing a lot of strength. The lending segment generated $642 million of Gate 8 revenue, up 55% year-over-year. Contribution profit was $382 million, up 60%. So lending is still the biggest profit engine of the company, and right now it is performing very well. The good news is that demand is strong. SoFi's margins in lending are attractive, and the company is benefiting from its bank charter and deposit base. That bank charter is really important because it allows SoFi to fund loans with deposits instead of relying as heavily on more expensive forms of funding. Deposits reached $42 billion, up $2.7 billion from the prior quarter, and management estimates that the shift toward deposit funding reduces annualized funding expense by about $622 million. That is a real advantage. A lot of fintech companies can build nice apps, but not all of them have a bank funding model behind them. SoFi does. And that funding advantage helps support net interest income, which was $693 million in the quarter, up 39% year-over-year. But here's the concern. Lending is great when credit is healthy, demand is strong, and capital markets are supportive, but lending is also cyclical. If the consumer weakens, if charge-offs rise, if loan buyers become more cautious, or if fair value marks move against the company, SoFi can get hit. So when I look at lending, I see both sides. It is currently a strength. It is also one of the biggest sources of risk. The third major positive was financial services. Financial services revenue rose 41% year-over-year to $428.5 million. Non-interest income grew 55%, and net interest income grew 31%. This segment matters because it shows SoFi is becoming more than just a lending company. The long-term dream for SoFi is not just to be a personal loan machine. The dream is to become a broader financial platform where people can bank, invest, borrow, manage money, and use multiple financial products in one ecosystem. That is why products like Money, Invest, Relay, Credit Card, Crypto, and Referral products matter. Now, not every one of these products is equally important today. Some are more mature, some are still early, some may be more about engagement than immediate profits. But directionally, this is the part of the business that supports the super app thesis. And this is also where fee-based revenue becomes important. Fee-based revenue was $386.8 million, up 23% year-over-year. That is important because it diversifies SoFi away from pure balance sheet lending. The more SoFi can generate revenue from fees, referrals, platform activity, and financial services, the less the business depends only on taking credit risk on its own balance sheet. That brings us to the loan platform business. This is one of the areas investors were watching closely. The loan platform business added $140.8 million to consolidated adjusted net revenue. SoFi originated $3.0 billion of personal loans on behalf of third parties and through referrals. The basic idea here is that SoFi can originate loans without keeping all of them on its own balance sheet. That can create a more capital-light revenue stream. And that is a good thing, because the market generally likes financial companies that can generate fee revenue without tying up a ton of capital. But the issue is that expectations were high. Investors Business Daily noted that investors were disappointed because loan platform fees and platform volume came in below some expectations. So this is a good example of the quarter being strong, but maybe not strong enough in every area for what the stock was pricing in. The business is executing, but the market wants to see proof that these capital-light revenue streams can become larger and more predictable over time. Now, let's talk about the weak spot, because there was definitely one. The technology platform was the weakest part of the quarter. Technology platform revenue fell 27% year-over-year to $75.1 million. Contribution profit fell to $12 million, down from $30.9 million. Total accounts fell 16% year-over-year to 133 million. Part of this was because a large client fully transitioned off the platform before the end of 2025. But still, this is a real negative. The technology platform was supposed to be one of the key ways SoFi diversified away from consumer lending. It was supposed to give SoFi more of a fintech infrastructure angle. Right now, that part of the business is not showing the same quality of growth as lending or financial services. Management is relaunching the business under SoFi Technology Solutions, covering areas like processing, banking core ledgers and services, payment hub, and risk and fraud. That could be interesting over time. But for now, I would not give SoFi too much credit for this segment until the numbers actually stabilize. The idea makes sense, but the current trend is weak, and that is one of the reasons I would describe this quarter as strong but not flawless. Now, SoFi also had some newer initiatives that are worth mentioning. The company began minting SoFi USD, a US dollar-reserved stablecoin, and is working on settlement capabilities and interoperability between digital assets and fiat currencies, including through MasterCard. SoFi also launched big business banking. These could become strategically important later, but personally, I would treat them as optionality, not core valuation drivers yet. Stablecoins, crypto infrastructure, payment rails, and business banking could open up new fee pools, but they also come with regulatory complexity and execution risk. So I would not base the investment thesis on these areas today. They are interesting, they are potentially valuable, but investors need to see actual revenue impact before assigning too much value to them. Now let's zoom out and talk about business quality. SoFi's business quality has improved a lot. The company has a large and growing member base. It has a cross-sell flywheel. It has deposit funding. It has multiple products. It has strong lending economics. And it has increasing fee-based revenue. The most important structural advantage, in my opinion, is the combination of digital customer acquisition and a bank funding model. That is what makes SoFi different from a lot of earlier fintech stories. A pure fintech app might have great user growth but weak economics. A traditional bank might have deposits and lending profits, but slow growth and outdated technology. SoFi is trying to sit somewhere in the middle. It wants the growth profile of a fintech with some of the funding advantages of a bank. That is attractive, but the moat is still not as strong as something like a dominant payments network or a mission-critical software platform. SoFi's moat is more about brand, product, bundling, deposit funding, customer data, underwriting capabilities, and capital markets execution. That is a real moat, but it is not unbreakable. The biggest question is whether SoFi becomes a truly durable consumer finance platform, or whether it ends up being a well-executed digital bank that is still highly exposed to the credit cycle. That distinction matters a lot for valuation. If SoFi is a high-growth financial platform, the stock can deserve a premium multiple. If SoFi is just a fast-growing bank with a nicer app, the multiple probably comes down. Profitability is where the story has clearly improved. SoFi delivered its 10th consecutive quarter of GAAP profitability. Net income was $167 million. Adjusted EBITDA margin was 31%. Management's 2026 guide calls for $4.655 billion in adjusted net revenue, $1.6 billion in adjusted EBITDA, $825 million in adjusted net income, and $0.60 in adjusted EPS. That is a big shift from where SoFi used to be. SoFi is no longer asking investors to believe that profits will eventually happen. Profits are already happening. But the question now is how much those profits can scale. And that leads into valuation at a stock price of $16.04 and a market cap of about $20.7 billion. SoFi trades at roughly 4.4 times 2026 guided adjusted revenue, about 26.7 times 2026 guided adjusted EPS, and about 2.2 times tangible book value. So is the stock cheap? On near-term earnings? No, not really. A roughly 27 times 2026 adjusted EPS multiple is not cheap for something with bank-like exposure, but SoFi is not being valued like a normal bank. The market is valuing it like a high-growth digital financial platform with expanding margins and a large cross-sell opportunity. So the better question is not, is SoFi cheap today? The better question is, can SoFi grow into this valuation over the next 5 years? And I think the answer is yes, but only if execution stays strong. At this valuation, the market is probably pricing in continued high teens to 20% plus medium-term revenue growth, sustained profitability, manageable credit losses, continued member and product growth, better diversification away from balance sheet lending, some stabilization in the technology platform, and limited dilution going forward. That is a lot. SoFi does not need to be perfect, but it does need to be consistent. If growth stays strong, margins keep improving, and credit quality remains controlled, the valuation can make sense. But if growth slows to the low teens, if credit losses rise, or if the market starts seeing SoFi as more of a normal financial institution, the stock can re-rate lower pretty quickly. Now let's walk through the 5-year outlook. In the base case, I would think of SoFi as becoming a larger and more profitable digital financial platform, but not necessarily a dominant megabank. Using management's 2026 adjusted revenue guide of $4.655 billion, the base case assumes revenue grows at an 18% compound annual growth rate from 2026 to 2031. That gets SoFi to about $10.6 billion of revenue in 2031. Then, if net income margin reaches 22%, that implies about $2.34 billion of net income. Assuming share count grows about 2% per year, diluted shares would be around 1.42 billion in 2031. That gets to EPS of roughly 1.65 put, a 22 times multiple on that, and you get a 5-year price estimate of about 36 per share. Compared with today's price of $16.04, that would be upside of about 126%. That is a strong return, but it depends on SoFi continuing to grow quickly while proving that its credit quality and funding advantages hold up through different economic environments. Now, the bull case is much more aggressive. In the bull case, SoFi really does become a scaled digital financial platform. Revenue grows at a 24% CAGR from 2026 to 2031, reaching about $13.06 billion. Net margin expands to 25%. Fee-based revenue becomes a larger part of the mix. Lending credit quality stays strong. The technology platform recovers. SoFi USD, Big Business Banking, and SoFi Technology Solutions add meaningful optionality. Dilution slows to about 1.5% per year. And the market gives SoFi a 28 times terminal PE multiple. In that scenario, 2031 EPS could be around $2.47. At 28 times earnings, that gives a 5-year price estimate of about $69 per share. That would be upside of roughly 331%. Now, that is obviously a big upside case. I would not treat that as the expected outcome. But it is possible if SoFi continues compounding at a rare combination of high growth and improving profitability. That is why people like the stock. The upside can be very attractive if the platform thesis plays out, but then we also have to look at the bear case. In the bear case, revenue grows at only 8% annually. Revenue reaches about $6.8 billion in 2031, net margin only reaches 12%. Credit losses rise, lending growth slows, the technology platform remains weak. Digital asset and enterprise initiatives do not become meaningful. Dilution continues at about 3% per year, and the terminal multiple falls to 14 times earnings. In that scenario, 2031 EPS would be around $0.55. At 14 times earnings, the stock would be worth about $8 per share. That would be downside of about 50% from the current price. And what's important here is that this is not a disaster scenario. This is not assuming SoFi blows up. It is simply assuming SoFi becomes a lower growth consumer finance company that the market values closer to a traditional financial institution than a fintech growth platform. That is the risk. When a stock is priced for strong execution, even a fine but not great outcome can still lead to poor returns. Now, let's talk through the key risks, because with SoFi, the risk side really matters. The first one is credit risk. SoFi's personal loan book is large and growing. Management says personal loan credit remains in line with expectations, but investors still need to watch this closely. If there is a recession or consumer credit deterioration, SoFi could face higher charge-offs, weaker loan sale execution, negative fair value marks, and lower investor confidence. This is probably the most important risk in the business. The second risk is lending concentration. SoFi has made progress diversifying, but lending still drives a large portion of contribution profit. If lending slows or credit worsens, earnings could take a real hit. The third risk is the technology platform. Revenue was down 27%, and accounts were down 16%. That challenges the idea that SoFi's infrastructure business is currently a strong growth driver. This does not destroy the thesis, but it does weaken the diversification story. The fourth risk is valuation. At around 26.7 times 2026 adjusted EPS, the stock does not have a huge margin of safety if the company disappoints. The fifth risk is dilution. Common shares outstanding rose from about 1.104 billion in Q1 2025 to 1.281 billion in Q1 2026. That is meaningful dilution. Now, the good news is that SoFi is profitable now, so dilution is less damaging than it was when the company was losing money. But shareholders still need to watch whether EPS is growing faster than share count, because at the end of the day, what matters to shareholders is not just whether the company grows, it is whether each share becomes more valuable. The sixth risk is regulation. SoFi operates in banking, lending, crypto, stablecoins, and payments. These are all heavily regulated areas. The move into SoFi USD and digital asset infrastructure adds optionality, but it also adds complexity. And then there is market confidence risk. Barron's reported that SoFi is dealing with investor confidence concerns following a short seller report by Muddy Waters, which SoFi denied. Even if the business performs well, controversy around accounting, credit quality, or fair value marks can pressure the stock. That is just something investors need to be aware of with financial companies. So what should we watch next quarter? The first thing is Q2 revenue growth versus management's roughly 30% growth guide. If SoFi can keep growing at that level while maintaining strong margins, that supports the thesis. Second, adjusted EBITDA margin. I want to see whether SoFi can stay around that 30% level while still reinvesting in growth. Third, net charge-offs and delinquencies, especially in personal loans. This is probably the most important risk metric. Fourth, loan platform business volume and fees. This is important because it can help SoFi grow in a more capital-light way. Fifth, deposit growth and deposit costs. The deposit funding advantage is central to the whole SoFi story. Sixth, technology platform revenue and account trends. Investors need to see whether that decline is stabilizing. Seventh, share count and stock-based compensation. Dilution needs to keep moving in the right direction. Eighth, progress in SoFi USD and big business banking. I would still treat these as optional, but they are worth watching. And ninth, any change to full-year guidance, especially management's $4.655 billion revenue target and 0.6 the adjusted EPS target. That guidance point is important because Reuters reported that shares fell after SoFi maintained its full-year forecast despite the strong quarter, and that kind of makes sense. When a company reports a very strong quarter, investors often want to see guidance raised. If guidance stays the same, the market may wonder whether management is being conservative or whether the rest of the year could be less impressive. So when I put all of this together, my view is that SoFi had a very strong quarter, but the stock is still a high expectation stock. Operationally, this was excellent. Revenue growth was strong, profitability improved, member growth was strong, product growth was strong, loan originations were strong, deposits increased, the balance sheet looks well capitalized, and SoFi is becoming a more mature financial platform. The long-term thesis is improving because SoFi is proving that it can grow quickly and produce real profits. But the thesis is not risk-free. The technology platform is weak, dilution is still relevant, lending exposure is still significant. Credit risk matters, regulation matters, and the valuation already assumes strong execution. At around $16 per share, I would call SoFi fairly valued to modestly undervalued for investors who believe in the 5-year compounding story, but I would not call it obviously cheap. This is still a high-risk, high-reward stock. If SoFi keeps executing, grows revenue at a high teens or low 20s rate, expands margins, keeps credit quality under control, and reduces dilution over time, the stock can still have meaningful upside. In the base case, I could see a path to around $36 over 5 years. In a strong bull case, the upside could be much higher. But in a weaker outcome, especially if growth slows and the market stops valuing SoFi like a fintech platform, the downside is also real. So my final view is bullish, but risk-aware. I like the direction of the business. I think the quarter was fundamentally strong. I think SoFi is becoming a much better company than it was a few years ago, but I would not ignore the risks or pretend the valuation is cheap just because the company is growing fast. For me, the most important things to watch from here are credit quality, member and product growth, deposit growth, loan platform business momentum, technology platform stabilization, and dilution. If those areas keep moving in the right direction, the SoFi thesis gets stronger. But if credit weakens, growth slows, or dilution remains too high, the stock could struggle even if the company continues growing. So that's my breakdown of SoFi's Q1 2026 earnings. Strong quarter, improving thesis, real profitability, but still a stock where execution has to remain very good, and for investors, that is really the key question. Do you believe SoFi can keep compounding like a fintech platform while managing risk like a financial institution? Because if the answer is yes, the stock can still be interesting. But if the answer is no, then today's valuation leaves much less room for error.